Welcome back, everybody. Our topic this week, should you buy and hold or should you trade? This is your host, Dr. Paul Price for Options Profits. Both these techniques can work very profitably. If you're a short-term trader, you're trying to capture quick moves in a stock or an option. It doesn't tie up your capital for very long, and it can be fun and profitable. All those are good things. On the other hand, if you try long-term investing, you're allowing time to get big moves in the underlying stock. You're allowing for value creation, which will be reflected over time in the company that you're investing in. It captures any dividends that that stock might pay, which matter a lot over the long term. And if you hold for more than 12 months under current law, you get very favorable long-term tax treatment, which you can't do with short-term trading. So, here's an example of a stock called Aqua America, symbol is WTR. It's a water utility with a very low beta of 0.65, and yet look at the chart. This is a decade-long chart from 2002 through this year, and it shows you that the low was $9.40 in 2002's bear market. The stock shot up to $29.80 in early '06, went all the way down into the 12s again in the '08 sell-off, and now is back to the 21, 22 range as I'm speaking in mid-October, late October. So this is a stock with a low beta that really has moved around quite a bit. Let's take a look at the actual data behind these moves and see if it really reflected what was going on with the stock, or was it reflecting market conditions. Well, here's that same long-term chart with those highs and lows marked, and let's look at the earnings per share. They went from 54 to 57 to 64 to 71. In '06, when it actually hit the high, it had a penny per share drop. Then in '07, it had a penny increase. So this is the stock that actually has been quite sedate in terms of earnings growth. It has grown long term, but in any given year, it didn't have a big move. It was 5.5%, 12%, 11%. A drop of 1.4 that regained that 1.4, 2.8, 5.5, 16%. The last 2 years have actually been pretty good, the best two in the last 11 in terms of earnings growth. So it's starting to accelerate, and yet look at the actual 1 year variation in stock price from $9.60 to $15 in the same year, from $11.80 to $16.80, 14 to 18, 17 to 29.50. 20 to 29. You wouldn't expect these kind of moves from a really low beta stock, and that's reflected too in the valuations. At the low point, this was 17.8 times earnings in '02, and at the high point it was almost 28 times. In '05 it went from 24.6 at the low, that was a hot market, to over 41 times. In '06 it went from 28.7 P to E at the low, which was pretty high in my view, to 42.6 times earnings at the high that year. And of course that was when you should have been sell, 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 as in Kramer talk. Now at the very bottom of '08, this was the lowest P to E on the entire page, 16.7 times that year's earnings, which were almost over, just because the whole market sold off so sharply. And by the peak that year, it was over 30 times. So the key on all this is, if you buy when the P to E has been relatively low, you had a chance to make some serious money with the stock. And if you bought when the stock was trading for more than 40 times earnings in late '05 and early '06, you got creamed. Let's take a look at a little further data on the same stock on the next slide. You can see that it has a decent financial strength. It has top 1% in value-wise view and stock price stability, which surprised me a little because this stock on the chart seems to move around quite a bit. It's outperformed 70% of all the stocks that Value Line covers for long-term growth in terms of the share price, and the earnings predictability as a water utility. People got to turn on the water no matter what is going on in the economy. The top 1% of all stocks that they cover, of more than 1,700 companies in their research universe. Here's what I really wanted to show you though. The 10-year changes in sales, earnings, dividends, and book value per share. All of these are split adjusted. It went from 270 to 555, or up 105.6% in sales, up almost 106% in earnings per share, up almost 107% in dividends per share, and the book value, using the end of the year estimates for this year, is up about 116% cumulatively over that 10-year period. Those are all very nice numbers, essentially more than a double over 10 years, good steady growth in every measurable category. What happened to the share price? If you had bought it to start the year, January 2nd, on a split adjusted basis in '01, it was $8.40, and as of January 2nd this year, actually the 3rd was the first trading day, it was $22.02. So you had actually done better with the shares at 162.1% from $8.40 to $22.02 than even the share price was justified based on the earnings and the sales increase. A very, very good long-term return on a very conservative stock, and that doesn't even include dividends that averaged over that 11-year period. It averaged almost 45 cents per share, or 5.33% annualized, based on that starting price of $8.40. So, how does this stock look now as of October 18th? Well, it closed last Friday, or I should say on the 18th, at $21.55. It had a yield at that price of 3.1%, which is not too bad in today's market. It had a P to E of 20.5, which, while it's not the lowest it's been in the last 10 or 11 years, it's close to that based on history. It has a P to E of just 19.6 times next year's estimate, and again, the earnings predictability here is very high. The conclusion is this is a relatively undervalued stock, and I just want to tell you I have no position in this stock. It's just being used as an example of what you can do long term with a conservative dividend-paying stock. Thanks for joining me again today. This has been your host, Dr. Paul Price, for Options Profits.